Welcome back to Carlton for Life. Today, we're going to talk about why financial advisors hate whole life insurance. And by the way, I understand that not every financial advisor hates whole life insurance. I understand that there are financial advisors out there, they understand the need for it and they sell it, right? I'm not talking about them. I'm talking about financial advisors like Dave Ramsey, right? If you've ever seen Dave Ramsey on YouTube, I mean, he has a real hate for permanent cash value life insurance. He thinks it's crap, right? He tells all of his followers not to buy it. I'm talking about agents like Primerica agents, right? If you've ever come across a Primerica agent, they will tell you buy term, invest the difference, never buy permanent life insurance. They just don't believe in it, right? And when I started out in the life insurance industry, it would frustrate me that I would come across these Primerica agents or these Dave Ramsey followers, and they would just tell me that no one should be getting permanent life insurance. And because I understood that some people could benefit from permanent life insurance, it just frustrated me. Over time, I found out why these agents and financial advisors hated permanent life insurance. And when I understood why they hated it, it gave me a better understanding of how to speak to my clients that come to me and say, hey, I saw Dave Ramsey. Hey, I ran into an agent that told me I should never buy it, but you're telling me I should buy it. I was able to have a way better conversation with my clients when it came to permanent life insurance, right? Because I understood why those other financial advisors didn't like it or didn't believe in it, right? And I'm hoping by the end of this video, you will understand why they are so against whole life insurance. And by understanding their perspective, I'm hoping that it can help you make a good decision on whether or not permanent cash value life insurance is something that would fit into your wealth building strategy and if it's something that you should be getting. So let's get into it. Buy term, invest the difference. If you're in the market for life insurance or if you're doing a bunch of research trying to learn about life insurance, you will eventually come across those words, right? What exactly does it mean and why are financial advisors saying it, right? That's what we're going to talk about today. Because if you start to really look into this stuff, let's say you go on YouTube and you're just looking into life insurance, you will see that there's this huge debate between people that believe you should only buy term and people that believe you should also have life insurance, right? There's like no in between, right? People are really going hard saying, listen, never buy whole life insurance, never buy permanent cash value life insurance. It's crap. It's a waste of your money. And then on the other end, you'll have financial advisors or agents saying, hey, you should definitely be buying whole life insurance. It can definitely benefit you. The question is, why is there this dichotomy between whether or not you should or shouldn't be doing it, right? I think that when we start to understand why some financial advisors have taken this position, I think that we'll be in a better position ourselves to figure out whether or not we should be buying whole life insurance or we should only be buying term. So let's get into what exactly does it mean to buy term and invest the difference? What difference are they talking about, right? What they're essentially saying is if you come to a financial advisor and you're telling them you have a need for life insurance, or they're telling you there's definitely a need for life insurance, because listen, whether or not you want to just get term, whether or not you want to just get whole life, everybody needs life insurance, right? So you'll never come across a financial advisor that's like, you don't need life insurance. The real difference is whether or not you need term or you need whole life, right? When they say buy term and invest the difference, what they're saying is for the price that whole life insurance would have cost you, because whole life insurance, because it's for the duration of your life, it's more expensive. They're saying instead of spending all that money on whole life insurance, just buy a term policy. With the extra money you're saved by not paying for that whole life, you can invest that money in a mutual fund while the term is in effect. And then eventually you'll have enough money that you'll be self-insured, right? That's the idea. Why are you throwing money at a whole life insurance policy when you can take that money and get better returns? That's the idea. Let me give you a specific example, right? Let's say that a 30-year-old male comes to their financial advisor and they're saying they want $1 million. Mind you, these are arbitrary numbers, right? Like the financial advisor will talk to you about what's needed for your specific financial situation, right? But let's just say a lot of people like to say $1 million, right? So let's say a fairly healthy 30-year-old just got married, just had their first baby, just bought their first home, and they're looking into life insurance and they want $1 million. The financial advisor would give them their options, right? You can either get a temporary life insurance policy that will be in effect for a certain amount of years and then terminate, or you can get a whole life insurance policy that is going to be in force for the remainder of your life. Now, the financial advisors that say buy term, invest the difference, what they're essentially saying is a whole life insurance policy for $1 million for a 30-year-old that would last the duration of their life is $813 a month. On the other hand, a term policy for $1 million for 30 years is about $138 a month, right? What's the difference? 813 take away 138 is about $675. That's $675. That's the difference they're talking about. When they say buy term, invest the difference, they're saying buy this term policy for $138, and that difference that you would have been spending on a whole life insurance policy, invest it. Invest it in a mutual fund. Over the course of the 30 years that your term policy is in effect, you will be covered with $1 million of life insurance. When you get that person to be 60 years old, when you get 60 years old and this $1 million life insurance policy terminates and you no longer have life insurance, you will be pretty much self insured. You'll be 60 years old, and that 675 that you put into a mutual fund for 30 years, it should be enough money there that you won't even need that $1 million of term insurance anymore, right? That's the idea, right? The idea is to put that money somewhere that it'll get a better return instead of pouring it into a whole life insurance policy. Now, why do they advise this, right? Why is a financial advisor telling you that you should just do this and this is the better move? A lot of times what happens is when you go to a financial advisor and you're talking about life insurance, you start to talk about your financial situation in general, right? You disclose how much money you're making, how much disposable income you have. The financial advisor usually gets an idea of what your finances look like. And most times people are talking to this financial advisor and they're saying something like, listen, what's the best return I can get on my money? Where's the best place to put my money? Right. And when you tell a financial advisor that, it's their duty to figure that out for you, right? If you're coming to me and saying, well, what's the best thing to do with my money, and how can I make the most money on my money, a financial advisor is never going to advise you to get whole life insurance, because that's not the best return on your money, right? When you get a whole life insurance policy, you are paying for a product. You're paying for a death benefit, and depending on how much you're trying to get and depending on your financial situation and your budget, it can be expensive. It's definitely more expensive than a term policy, right? Like, you see the difference here. It's 813 for $1 million compared to 138 for $1 million, right? Now you got to understand something. Financial advisors, some of them are fiduciaries, right? And what that means is that they are ethically and legally obligated to ensure that they are doing what's in your best interest, not what's best for them, not what makes them the best commission. They are ethically and legally obligated to make sure they're doing what's in your best interest. And if you're coming to them and the sentiment is, hey, I want the best return on my money, you can understand. Sometimes these financial advisors are looking at it like, well, whole life insurance will never get you the best return on your money. Buying term and investing the difference, it will get you the best return on your money, right? Now, they are the financial experts that you're coming to for advice. So a lot of times people are going to believe them, right? I'm coming in, I'm telling you, hey, what's the best thing to do with my money? They're giving me this advice. That's where the idea of buy term and invest the difference come from. But let's look at the actual numbers, right? Let's look at what investing that difference looks like. Now, if someone called up their financial advisor and before they met with them, they were like, hey, can you give me some numbers, some quotes on a whole life and a term policy? Let's say that the agent gave them these numbers, right? The 138, 813 for the whole life, right? If they're already telling you this idea of, listen, you're going to buy term and invest the difference, people need to start using the internet, chat GPT, the things we have, the resources we've had at our disposal to try to get information before we go meet with these financial experts, right? And by the way, you should be doing this for every time you're going to see an expert, right? If you're going to see a lawyer about something, if you're going to see an accountant, get on chat GPT, look things up, get a baseline for the information that you're about to go get advice on, and then you can ask them. You can be someone that at least looks like they understand what they're talking about, and that way you're not. Listen, sometimes consultations cost money, right? Sometimes seeing a lawyer, they charge by the hour. Sometimes seeing an accountant, they charge by the hour, right? So you want to come in with the basics and pointed specific questions so that you're not wasting time and they're not making money off you just explaining the bare minimum to you, right? So I say that to say, if you've already kind of heard on YouTube a bunch of times buy term invested difference, if you got the numbers, you can go on Chat GPT and you can say, hey, if I've got $675 a month of disposable income that I can invest, how much would 675 a month turn into if I put in a mutual fund for 30 years? And by the way, I understand that Chat GPT isn't always right. I understand that going on Google and trying to look something up is not the best way to get information, but it will at least give you a baseline. You can take notes. You can bring it into the financial expert and say, hey, I looked this up. I checked the sources. They say that this is how much, is this accurate? And then at least that financial advisor, oh, okay, this guy knows a couple of things and he can either correct you or confirm your information, right? So I went on Chat GPT and I put it in. If I had 675 a month in a mutual fund for 30 years, how much money can I earn in the market, right? And the answer was, if you invest 675 per month in a mutual fund with an average annual return of 10% for 30 years, your total investment could grow to approximately $1,528,000. So over $1.5 million by putting that 675 in a mutual fund for 30 years. Right now, like I said, how do you know that's true, right? You can ask, what's your source, right? ChatGPT, what's your source, right? So if you were to ask, where are you getting these numbers from? They'll tell you. The numbers are based on the future value of an annuity formula, which is a standard financial formula used to estimate the value of recurring investments over time with compound interest. The formula is, and they give you the formula, right? Now, you can take that to your financial advisor and say, hey, this is the formula that I found. Is this accurate? Is this how much money I can have? And they can confirm it, right? The idea is to figure out what those numbers look like. What does investing the difference look like? Is it a good idea? So let's talk about it. Uh, you put about over $240,000. That's what 675 a month for 30 years. Over 240,000 into a mutual fund, and you can walk away with over $1.5 million. So how does that look? Over the course of 30 years, that you have your term policy in place, the $1 million term policy in place, you will be putting the difference instead of getting the whole life into a mutual fund. And after 30 years, when your term policy falls off, you're 60 years old, you have the potential to have this investment account with over $1.5 million in it. Now, what happens if you were to get the whole life insurance policy and put the whole 813 in there? What does that investment look like, right? Like what does putting your money into that looks like? And by the way, whole life insurance is never an investment, but because these financial advisors are pretty much comparing it to an investment, because that's what they'll say. They say, why'd you get that whole life insurance policy? You could have got this investment over here and made so much more. So the question is, how much more? How much more of a difference is it when it comes to investing your money? Let's take a look at it, right? So if you got that whole life insurance policy, after 30 years, you have the potential to have about $426,000 in net cash value that you would have access to. And your death benefit will have gone up to 1,120,000. So you got about 120,000 more in death benefit than what you started with, and you got about 426,000 in net cash value. And by the way, right, if you went to a trusted financial advisor or life insurance agent, they probably would have told you not to spend the whole 813 on a whole life insurance, right? They probably would have said you can accomplish your $1 million goal with some term and some whole life. This is just an example to get this point across, right? So let's just look at these numbers to compare the two. If that person would have got this whole life insurance policy for 813 a month, he would eventually have 426,000 in cash value that he would have access to. Whereas if he would have got the term policy and invested the difference, he'd have over 1.5 million. This is a big difference, right? We're talking about $1.1 million difference in what you would have access to. So this is why the financial advisor cannot fathom why would a person go put money into a whole life insurance policy and only have access to $426,000 when they can cover their need for life insurance for 30 years with $138, and they can possibly have over $1.5 million. What is the better option, right? If I'm coming to you and I'm saying, what's how can I get the best return on my money? Clearly, buy in term and invest in the difference is the better option. And that's why financial advisors cannot understand why anyone would go pour their money in whole life insurance. And it's logical. Right? This is not something that sounds crazy. This is a rational thing. Right? I understand why they're saying this, right? The problem that I have with buy term and invest the difference is it is planning for the best, it's not preparing for the worst. Best case scenario, you will be in a position that you can consistently pay $675 a month into a mutual fund, and that number will build the way it does, right? They're basing that 1.5, that more than 1.5 million, they're basing that off of historical stock market data, right? Over the course of 30 years, historically speaking, this is how the stock market has performed. It's never lost money, right? There's no 10-year period that the S&P 500 have ever lost money. If you have a 30-year horizon to put money away, then chances are, based off historical data, you could end up with $1.5 million. There'll be ups and downs in between, but they've averaged it out over time and they've come up with this number, right? And by the way, your financial advisor may use a different formula. Other people may tell you a different number, but this is the general idea of what it looks like. The fact remains that no matter what numbers you plug in, no matter what policy you get or what mutual fund you put it in, right? The S&P 500, the mutual fund account will always outperform when we're looking at illustrations and projections. It's always going to outperform a life insurance policy. Why? Because a life insurance policy, money that you're putting in there is going to pay for life insurance. You're paying for a product. That 675 that you're putting into a mutual fund, every single dollar besides fees obviously is going to work for you. Like, it's supposed to be an investment. So you're always going to get a better return than you would on something that is just to pay for a death benefit. So while you're planning for the best, you have to understand you're not preparing for the worst. What if something happens to you where you're not able to any longer put in 675 a month into that mutual fund, right? You have your $1 million of term life insurance, but what if in between the term and you putting money into this mutual fund, what if something goes wrong? What if you get, God forbid, what if you get hit by a car and end up unable to work and have an income, and then you can't put money into this mutual fund anymore? Right? I mean, you still have your life insurance, but you're disabled and you can no longer pour money into the mutual fund because you're not working anymore. You know, if you don't have a disability insurance policy, right, which is something different. We didn't even talk about that. Maybe your financial advisor finds that for you, but let's say he doesn't. Let's say this is what you have. You bought term, you invested the difference, but something bad happened that your income got disrupted, right? 9 out of 10 times, if this is where all your money is going, you're gonna have to dig into this mutual fund, right? You might have to withdraw some of this money, and if it's a retirement account, there may be penalties, right? There may be taxes to pay. What if the stock market is down when you have that unfortunate event? What if your account is down 10, 20% at the time that something happened to you, that you got injured and couldn't work anymore and were disabled, and you needed to pull money to sustain your lifestyle out of this mutual fund? Right? What does that look like for you? You've disrupted the compound interest. God forbid you had penalties. God forbid you had to pay taxes. You experienced all of that. And what does that look like for the next 20 years, 30 years until you're supposed to get that $1.5 million? Have you prepared for that? Right? Now, had you got the life insurance policy, you're probably thinking, well, it's the same difference, right? I paid 813 a month. If I get into an accident and I'm unable to keep paying this, how is the policy going to lapse? Well, there's something called a waiver of premium for disability rider, right? Where if you become disabled for an extended period of time, if you have this rider, which your agent, if they're smart, they'll have you get it because the rider is very inexpensive, right? If you become disabled, the life insurance company will continue to pay your premiums for you for the duration of of your disability, right? So the mutual fund's not going to do that for you. There's no, unless I don't know about it, there's no mutual fund out there that's going to continue to pour that 675 a month so you can build up to that 1.5 million, right? The life insurance policy does. Now, let me give you an example. Let's say in 10 years, right, when this person, he's got this policy at 30, at 40 years old, God forbid, let's say he gets hit by a car, right? He has the potential to have, if this is a mutual company and it pays a dividend and a dividend is paid every year, he would have a potential to have $97,000 that he would have access to, right? $97,000 would be his cash value, right? If he became disabled and the life insurance company continued to pay his premiums, he wouldn't have to worry about his insurance policy lapsing. And he would have access to $97,000 to help get him by, right? He could borrow that money from the company. There'd be no repayment schedule. They wouldn't worry about his credit. Like, well, how's your credit at this time? What's going on? It doesn't matter. If the market is down, guess what? The market could be down 20%. Doesn't matter. This life insurance policy that he has, this money is not in the market. So he would have this $97,000 to sustain himself, right? So who's in a better position? The guy that bought term and invested the difference, or the person that had the whole life insurance policy and paid more, right? Who is better prepared? When life insurance agents solely focus on the best case scenario and the best return on your money, I wonder if they're also focusing on uh, the worst case scenario. And that's what life insurance is truly about. It's preparing for worst case scenario. So maybe it does make sense to get a mix of term, whole life, something that can protect you in case something like this happens. Maybe you take some of that money and also put it in a mutual fund. But I can't understand for the life of me why these financial advisors are just saying never get whole life, because you can't tell me in this scenario having whole life insurance couldn't be beneficial to you, right? But let's take it a step further. Let's say that you're fortunate enough to continue to pay the 675 a month for 30 years. Let's say at 60 years old, the term policy has fallen off, and let's say you do have this 1.5 million. Everything worked out. Did you know that 5 years later, when you turn 65 years old, there's a 48% chance that you will have to pay for a long-term care scenario, right? Long-term care services. What's long-term care services? If you cannot perform two of the six habits of daily activity, which is, let's say, toileting, moving from one place to another, dressing yourself, eating these things. If you cannot do these things for an extended period of time without assistance, then you're in a long-term care situation. That can happen from having Alzheimer's, that can happen from a chronic illness. Maybe you had a stroke, maybe you had a heart attack. There's a 48% chance, that's half, 50% chance that you will end up paying for these services. Who do you think pays for these services? Right? Medicaid will not pay for these long-term care services until you only have $2,000 in assets. So if you've racked up $1.5 million, then you're going to be paying for those long-term care services. Do you know how many people have spent a lifetime building wealth and trying to set themselves up and ending up having that account drained by long-term care services? Right? Did you know that 70% of people 65 and older will have to pay for long-term care services? And on average, long-term care services last about 3 years. You know how expensive long-term care services are, right? If you wanted your own private room, if you wanted to go into a nursing home, over $100,000 a year, right? And if you live in a place like Jersey or New York or these expensive cities, it's even more expensive, right? Are you prepared for that? Has buy term investor difference prepared you for that? How much of that 1.5 million is going to be drained by the fact that you have a 50% chance at 65 of being in a long-term care situation and a 70% chance at 65 and older? Maybe these numbers don't matter to you, right? Some people, that ain't going to happen to me. And if that's how you feel, and if you just want the best return on your money, then that advisor that told you to buy term investor difference, he's a good fit for you. But the people that are concerned about this, the people that want to make sure they have something in place in case they end up in a long-term care situation, paying for long-term care, if they are wanting to protect themselves, then guess what? Whole life insurance has evolved in the last decade or so to have accelerated benefits, and some policies have long-term care riders that will pay for your long-term care services and protect your wealth. You won't have to sell your house. You won't have to dig into your mutual funds, your 401k. This life insurance policy can protect you and your family and pay for those long-term care services. So these agents that say, don't worry about it. Put your money in this mutual fund. It's gonna grow. What if when that long-term care situation happens, let's say you have that 1.5 million and you're like, man, uh, that should cover any long-term care situation I have and still give me enough money to take care of myself and take care of my family, God forbid something should happen to me, right? What happens if the market is down when you end up in that long-term care situation? What if it's dropped 20%, your mutual your fund has dropped 20% and you need to access it for these long-term care services, right? You're planning for the best, but you're not preparing for the worst. So you can't tell me that whole life insurance doesn't have or serve a purpose, right? For the people that are concerned and want to prepare for that, whole life insurance beats buying term and investing the difference. And right, and these are all like bad things, right? These are all negative things. That's not the only thing to think about when it comes to buying whole life insurance, right? Because we also have to look at the fact that the person that has built up a cash value in their whole life insurance policy, that person that has $426,000 at 60 years old, he has access to that money tax free. He can get access to that money and do whatever he wants with it. We're not thinking about the opportunity that that person has had over the last 30 years to be in control of his investment, right? Buy term, invest the difference is your financial advisor telling you, listen, you came to me for advice. I'm going to give you the advice. Give the mutual fund and the mutual fund managers control over your future, right? You've given up your money, control of your money to the stock market, and you're hoping that in 30 years, it's going to be that big $1.5 million that you can have access to. But when you do that, you've given up control, right? The person that has this whole life insurance policy, like I said, after 10 years, when he's 40, he'll have $97,000 in cash value that he can do whatever he wants with, right? And maybe that number is bigger in the mutual fund, right? Let's say two people did it. That the person with the mutual fund might be like, oh, I got 140,000. You only got 97,000 in yours, right? Who's better off? That person that had a better return that thinks, oh, I got more money, they can't even do what they want with that money. They can't even access that money because if their plan is to leave it there and get that 1.5 million and they're banking on the stock market doing what it does and what it's done historically, they can't touch it because the compound interest has to keep growing. But that individual that has that 97,000, let's say in the last 10 years, he's been studying up on real estate investing. Let's say that he's been meeting some mentors and networking and understanding how to invest in real estate. What if with that $97,000 after 10 years, he's comfortable, he's mitigated his risk by educating himself on investing in real estate. And let's say he partnered up with somebody and went and bought a multi-family property, right? Let's say that he's successfully done that. And every 2 years after that, he continues to buy multi-family properties, right? So although that other person in that moment may have had more money because the returns were better for him, who in the end, who 30, 20 years from now will be in a better financial position? Is it the person that bought a rental property every 2 years, right? I mean, what if that person starts educating themselves on how to buy an asset and make a cash flow off of it? Did you know that even if you're a W 2 employee, there's something called a $25,000 offset that you can offset on your W 2 income up to $25,000 in real estate losses, right? As long as you make under 100,000. If you make over 100,000 up to 150, then you get half of that, 12,500, right? But think about that. You buy a rental property, you make $100,000 a year, you can write off $25,000 in real estate losses. And with depreciation, you can take a loss on paper, but you can still make money, right? You can still make money, but because of depreciation, you can take a loss on paper. And every year it's not going to be 25,000 in losses, right? But what if it's just 10,000, right? What if you can write off 10,000 in real estate losses every year. Are you better off than the person that just was hoping that the market was going to do what it was going to do? Right? I think that there are some people that are willing to be in control of their financial future, and that it might make more sense for them to get a whole life insurance policy, have access to that net cash value. And even though that net cash value will never equal what the value of a projection for a mutual fund would look like over 30 years, it doesn't mean that one person picked a better plan than the other, right? Because we don't know who's going to be more wealthy in the end, right? It really depends on how you want to invest and what you feel comfortable doing. So, to all the financial advisors out there that are saying buy term, invest the difference, you'll never get a better return, I think what they're failing to take into account is that not everyone has the same relationship with money as everyone else. There are some people out there that don't want to give up control of their money to a mutual fund, right? You lose all control of your financial future when you depend on the stock market returns to build your wealth. But if you can educate yourself on things to do with your money and you have tax-free access to your money, what are the possibilities, right? The possibilities of the mutual fund is okay, I can get 1.5 million. What are the possibilities of someone that learns real estate and buys a property every 2 years? Could they possibly have more than a net worth of 1.5 million? Could they possibly have more assets, right? More flexibility, cash flow, right? You don't even have cash flow when you're putting your money into a mutual fund. If you get a real estate property and you do it the right way, you could possibly have cash flow to help you today. Instead of waiting 30 years, you could have cash flow today to help with your expenses. What if I read a book, stock market cash flow, right? Look up stock market cash flow. What if you could use this money to go buy some shares when the market is down, right? Let's say the market crashes and that guy with the mutual fund is sweating because the market is down. What if you took some of this money, went and got some shares, and then started to make cash flow by selling covered calls on your shares? What if you really educated yourself in how to do that? Right. And I know people are gonna be like, oh, that's super risky. Oh, real estate is super risky. Your tenants to stop paying. Oh, you talking about investing in the stock market and getting cash flow and selling covered calls. Oh, listen, I've already realized that there are people out there that just want to give up control of their money to a mutual fund and hope that that's going to turn into what it's going to turn into. And for those people, yes, buy term, invest the difference. But for the people that want to pick up a book and educate themselves on how to make cash flow in the stock market, for people that want to learn real estate, pick up a book and learn real estate and invest and have access to their cash. I mean, look at this. In 10 years, this person will have $97,000 in cash, potential to have 97,000 that he can access, right? In 15 years, he'll have $156,000, right? What could you do with all this money? While the person with the mutual fund is looking at that account and he's like, yeah, I got 100,000, I got 200. They don't have access to that. They can't touch it. It has to keep growing. They have to rely on the stock market to keep doing what it does. This person could say, you know what? Let me go buy a car and put it on Turo. You know what? Let me go buy 100 shares of Tesla. It's down 20% right now. Let me go buy 100 shares of Tesla and sell covered calls on Tesla when it bounces back, right? Let's say that whatever they're doing, they're coming up with different ideas, right? And I think when I speak to my clients now that come to me and say, hey, I saw Dave Ramsey, he said to never buy permanent life insurance. I spoke to a Primerica agent. They told me I should only buy term and invest the difference. I think the conversation that I'm having with my clients now is, what is your relationship with money? Are you the type of person that wants to give up control and just put in a mutual fund and let it build over time? And that's what you're comfortable with? Are you the type of person that want to educate yourself, figure out ways to get money, ways to get cash flow, be an active part of your investment strategy? That's all it comes down to, right? Are you the type of person that's worried about you getting sick, you being disabled, you ended up in a long-term care situation? These are the questions these financial advisors should be asking. But I think a lot of times they get distracted by the idea of getting the best return, right? Because people are asking them, hey, give me the best return on my money. And yes, a mutual fund technically would be the best return on their money. But the problem is you're planning for the best, not preparing for the worst, and you're giving up control of all your money to a mutual fund. If you thought this information was useful, please like and share the video. If this kind of information is something that you feel is helpful to you, please subscribe to the channel. Right? The idea is to start understanding why our financial advisors and why our life insurance agents are giving us specific and pointed advice and not just taking it for what it is, right? Educating ourselves. Look, go on Chat GPT, ask. If you think the source is not good, hey, what's your source? Double check. Go into your financial advisor's office and ask, hey, I looked this up. What is this? Become knowledgeable and let's stop being ignorant to finances because we're busy at our job, we're busy with our children. It only takes a couple minutes. If you can binge watch stuff on Netflix, you can take some time to try to educate yourself on finances and try to understand why you're getting the advice you're getting. Because when you understand why you're getting the advice you're getting, you'll have a better understanding of if you should or shouldn't take that advice. Thanks.